It is Will Laubach. He is going to cover accounting technical updates. Will is a member of the firm at SEK. He resides in our Camp Hill office, joined SEK in 2025 with 15 years of experience currently. He graduated from West Virginia University with a bachelor's in accounting. He serves a variety of industries at the firm and in previous firms, but he specializes in nonprofit and government contracting. He's involved in various technical committees within the firm and currently helps lead some firm initiatives on new technologies, new audit approaches, and standardization. And I will pass it over to you, Will.
All right. Thank you, Christina. And thank you everyone for attending today. So the purpose of my section here is that we're going to go over some accounting technical updates. So really the two main goals are to reiterate some areas that we see that is not necessarily new guidance, like revenue recognition, some updates in the uniform guidance, some lease accounting, really just touching on some areas that, we see a lot of our clients either struggle with some of the technical nature of it or we just see errors in practice. So we wanted to just go over that at a high level. Certainly, if there are any questions as to more specific circumstances, we can get into those. But the goal today was to stay somewhat high level and remind you of some of the nuance of some of those areas. And then also go over, there's a couple of new accounting pronouncements that are upcoming in the future years that may impact nonprofits. So we're going to start with getting into revenue recognition and contribution accounting. So this is one where for the folks on the call, as having a role within a nonprofit, this is one of the most important determinations that you have to make because most nonprofits have various different funding sources and types of contracts. A lot of nonprofits have membership type services. They have true contributions where they're getting grants or donations. So the really important determination with any of those different types of funding streams is whether or not is that an exchange transaction where it's under ASC 606, kind of the normal revenue model, or is that funding source or that revenue stream more of a contribution, a non-exchange transaction, which falls under ASC 958-605, which is the contribution revenue for nonprofits. So we see a lot of errors in this, and it's really important that whenever even if it's an existing funding source or a new funding source, that you're really analyzing which model this goes down because it really impacts a lot of things within your financial statements and within your financial reporting. There are different guidance, there's different disclosures, there's different subsequent accounting. So getting it right on the front end is extremely important. And really what the main pivot point is whether or not the transaction is reciprocal or whether or not there's commensurate value. So we're going to get into those topics on the next slide. So on when it comes to an exchange transaction, that's a little more apparent. That's the revenue recognition model, ASC 606, that pretty much the rest of the world uses besides nonprofits. But nonprofits use as well if you have a contract with a customer. So it's a five-step model that's focused on whether or not recognizing revenue as control is transferred to the customer. And so inherently, as it affects nonprofits, it's a contract or a transaction in which each party is directly receiving commensurate value. So that's really the distinguishment there, is that it has to be direct to both parties and has to be commensurate value. So you may be saying, well, what is direct? That means that it's the party themselves. Both parties are getting it. So sometimes you have a grant or something, some other type of funding source where kind of the goal is to benefit the greater good or the public in some way. That's not a direct benefit to the party that provided the funding. So in that case, that's not a direct funding or a direct relationship, and it likely wouldn't be an exchange transaction under 606. So there are some indicators of what constitute direct and exchange transactions. So you think about who will use the goods or services, who's going to derive the benefit or the value from those goods or services, and or who's going to own or control those goods or services. If it's the party providing the funding, then that is highly indicative of an exchange transaction. And then once you're in that, then you go down the rev rec model, which you may or may not be familiar with, but it's pretty simple. There can be some caveats, but you identify the contract, identify the different performance obligations. So that's where maybe you have one agreement, but within that agreement, you're providing four kind of distinct services. So that's where you would need to identify those. You determine the transaction price. Then you allocate the transaction price to the different performance obligations and you recognize the revenue. So for a lot of nonprofits, you'll see a mix of some funding sources are within this Exchange 606 model. And then there's disclosures that come with that. So it's very important to get that right. And really, like I said, the important part is making sure that on the front end, you're looking at your contracts, your transactions, and determining should it be a transaction that falls under an exchange model. Transversely, onto the next slide, if you are not an exchange transaction, then you're under contribution accounting for a nonprofit, which is a voluntary, non-reciprocal transfer or a promise to give, which I'll touch on that in a minute, of cash or other assets, or even a transaction or a cancellation of a liability. So really that's kind of what I was saying earlier. If you're receiving funding and it's either not a direct benefit to that party, but it is going to benefit the greater good or your programming in some way, then that is going to fall under this contribution accounting. So, two really important topics when it comes to contributions that we see frequently missed or frequently kind of interrelated is that there's a condition and then there's restrictions. And they sound like the same word, but they're very different as far as what they mean within 958-605. So, a condition is a barrier that must be overcome in order for you as the recipient organization to be entitled to those assets. And if you fail to overcome that barrier, then there might be a return of assets or a release of some kind of commitment that the donor made. So that's really important because think of that as like something I need to do in order to earn the money. Now, there can be restrictions, and that is different from a condition of the funding. Now, a restriction is also very common. If you work for nonprofits for any period of time, you've probably seen restrictions, or I'm sorry, yes, restrictions on contributions where the funding source, the donor, is saying, we want you to use this for this specific program, or we want you to use this next year in this capital campaign. So that's very different because that is a restriction on the use of the asset, but it's not an inherent condition on whether or not you've earned the funding. Very important distinction because a condition where it is a barrier you have to overcome affects the timing of your recognition of the contribution. So you don't recognize a contribution as income until you've satisfied all the conditions. So, but a restriction, if you receive a grant, for example, that has a restriction saying we want you to use this for this program, but there's no conditions, it's kind of free and clear money, and there's no way that you would have to return that in any way. Even if that's not payable for 2 more years, you still record that because there's no conditions. So that's a tough one to comprehend sometimes. Like sometimes we've seen it where you might get a grant that's payable over 5 years, but there's really no conditions to getting years 2, 3, 4, 5. There's really no barriers that say you have to achieve X in order to get year 2 or year 3. So in that situation where you get a 5-year grant and you get all the money on day, or I'm sorry, you only get 1/5 the money on day one, you would actually record the entire contribution income as a promise to give on day one. Now, granted, there's some present value considerations to that, but that can be sometimes difficult to think about whenever the payment isn't concurrent with the grant agreement itself or the promise. So keep that in mind that a condition, it, the timing of payment is not a condition. That can be a restriction, a timing restriction, but it's not a condition in order that you would have to possibly give the money back. So, very difficult concepts to keep in mind. We see this frequently missed or frequently not documented correctly. So, bear in mind, and if you have restrictions, that is important for your financial reporting, and that you've probably seen statement of activities or like your income statement where there's a column for with donor restrictions and a column for without donor restrictions. And then there's transfers between the two as you satisfy those restrictions. But that does not affect, those restrictions do not affect the timing of your recognition. The timing of your recognition is driven by the conditions, whether or not they're there. And where it can get really tricky in the last bullet point is an agreement can be one singular agreement can have elements that are contributions, exchange, or a combination thereof. So it can get very tricky when you're trying to go through those type of things and make sure that you're really following the guidance and understanding conditions and restrictions. So on the slide, what you can see here This is actually directly from the guidance, so I really do like this flow chart. And in general, I like flow charts. I think it's very helpful for understanding. So this flow chart helps you distinguish between whether or not it's an exchange transaction under ASC 606 or whether or not it's a contribution. And then it even gets into whether or not there's conditions in order to recognize the income or if there's restrictions. So this is a good flow chart that basically summarizes everything I just went over at a very high level. So kind of burn this into memory, keep this in your policies and procedures. Very helpful flow chart. Now, obviously, you need to understand the terms, and that's where folks like us can help with some of that or some technical research, but very helpful flow chart.
Hey, Will, I'm going to interrupt quick. We got a question. If you
Sure.
receive a grant and need to spend it by a certain date or return the amount not spent, is that a restriction or a condition?
So in that situation, that would most likely be a condition. And essentially what you would be doing, the way the guidance would interpret that would be to say that that is a condition, and as you're incurring costs that are allowable within whatever that program is, that's basically the satisfaction of the condition. So you would pretty much be recognizing the contribution income as you satisfy the restriction, or as you satisfy the condition, I'm sorry. So then when it comes to the summary of this and really the takeaways for the folks on the call, number one, most important, this is going to be a recurring theme, have a good documented accounting policy, have good templates and flowcharts and things that are going to help your accounting and finance teams, especially if you're in an organization where you don't have a heavy accounting or finance team or you're relying on maybe a treasurer to help with some of this type of stuff. Really make sure that you're looking at accounting policies, and make sure the policies start with distinguishing between the two and then going down the models of each one. Second point, you're all achieving it today by being on this training. It's really education and training for your team about the different concepts, what the importance of each one is. Um, Probably a really good takeaway, the third bullet there is really having good communications with your donors and your funding sources. So if something is ambiguous or unclear, we also know it's somewhat common to receive funding without being supported by formal agreements or grant agreements, things like that. So if it's unclear whether or not there is a restriction or whether or not there is a condition, clarify that with your donors. Go right to the source, say, hey, this is our understanding of the situation. And then that way, do that via email or do it some documented way so that when when we come in as your auditor, we have support and that you have support in case any other entity starts challenging that. So that's a really good point to have. And then, of course, if something is unclear, if you're struggling with a concept, work with your accountants. Board members are a great source, any other subject matter experts to make sure you're following best practices. There's a ton of different templates, there's a ton of different guidance that you can lean on to make sure you're getting these pieces right. So next section, this is almost a year old at this point, but it's still new for a lot of for a lot of different nonprofits, and frankly, a lot of government agencies haven't really dipped their toes too hard into the enforcement of some of this. But there was, I'm sure probably many of you were familiar, back in the end of 2024, there were some really significant changes to the uniform guidance. So what is the uniform guidance? It's 2 CFR 200. It's the really the framework for administering and managing any federal awards. So if you have grants from the federal government, or even if you have grants from a state government where the funding is from them is coming from federal agencies. So if you've had single audits in the past, this is very relevant to you. So the changes became effective October 1st, 2024. They were prospective changes. So really for the years, and if you have our calendar year, September 30, 2025 or later, then this is in play for you. So really as of today, pretty much all nonprofits, this is applicable to. Um, so there were a ton of changes that came about. By volume, most of them were kind of technical updates or clarifications, but I'm going to go over a couple of the really big ones. So the most and the biggest one is the third bullet point there, the increase in the audit threshold from 750,000 in expenditures to a million. So fingers crossed, our hope for you guys is that if you're an entity that you've always had in that neighborhood of 750,000 of federal expenditures, and so you've needed single audits and it's a very onerous project. Now, if you're up to a million and you might be below that and you might be exempted from needing a single audit. So hopefully if you've been right around that line, look at that, see if it changes anything for you from going forward. Um, could also impact your subrecipients. So if you're an entity where you have subrecipients that are doing work that you're passing money to, same rule applies. So you may have subrecipients that may or may not require an audit depending on the amount of pass-through funds to them. Similarly, the last point there, the type A threshold. So if you're not overly familiar with this, so basically as an auditor, when we come in and we're doing a single audit, we go through all the awards and we determine which are type A, which are type B, and generally you end up auditing more of the type A. So as a very broad rule, the less type A you have, the less grants that we're auditing, which makes everyone's life a little easier because it's less audit requirement. So they also increased the type A threshold from 750 to a million. So what that might mean in practical sense is less major programs being audited, meaning less audit testing. So both of those very good, very favorable to nonprofits to hopefully make life a little bit easier. Continuing on, oh, looks like we got a pop up there. So everyone make sure you answer that question as we progress on to the next slide. So another big change, the de minimis indirect rate threshold went up from 10% to 15%. So in some of your awards, there's basically a ubiquitous rule that if you don't have any kind of negotiated indirect cost rate, you can just apply a 10% indirect cost and include that in your billing to the government for most awards. That was increased now to 15%. But very large asterisks on that. You have to be really careful because it's not an automatic increase. It generally only applies to new awards that were issued on October 1st, 2024, October 1st, 2024 or later. So some agencies can go back and retroactively amend to include that 15%, but if they do that, then there can be budgetary issues with, if they don't change the overall budget for the award, but they're allowing more indirects, what does that mean as far as the program and being able to achieve all the goals? And you can have a mix at any point in time. Like right now, you may still have awards that were in place prior to October 1st, 2024, that you're still charging the 10%, and maybe you have a mix of new ones. So you can, within one audit, have certain awards at 10, certain at 15. But overall, the good news is that for new awards going forward, if you're an entity that has historically just used that 10%, now you'll be able to recover more indirects with new awards going forward. And so this is another big one that I've seen a lot of discussion between the recipients and the awarding agencies as far as how you're going to apply this, what it means for the budget, what it means for the award. So just know that the increase did go up, but do not just tomorrow start changing all of your invoices and your drawdown requests to be 15% instead. Definitely have conversations first with your agencies. A few other increases in thresholds, really just to bring it in line with today's dollars. So they increased the threshold for calculating modified total direct costs, which again kind of goes back to your indirect calculation, but they did increase that so you can include more subaward costs from 25 to 50. They did increase the equipment capitalization threshold from 5,000 to 10,000. So hopefully what that means is if you're an entity that has a lot of government funded equipment, and if you have that, you probably know that there's a very administratively burdensome to track all that, tag it, do inventory every 2 years at least. So this may result in having less equipment that you need to capitalize and track. And then there, like I said, there were some other kind of definitional and language changes, but the last couple that we just went through were the really big, impactful ones that we expect to really affect nonprofits more in the day to day. So again, similar to the previous section, just recommendations. With these new changes, make sure that your policies and procedures and controls are updated. It's very important note on the controls there because if, for example, you have an internal control document that says you capitalize equipment above $5,000. If you don't update that policy to say 10,000 to be in line with the new guidance, you the audit rules and the regulatory rules will still follow your 5,000. So make sure you're updating your controls and policies and procedures to be in line with these new thresholds. Again, education and training, you're doing that today. But of course, if you have additional questions or want to dive into these a little bit deeper, we're always here to support that. Again, clear communications with your grant and contracting officers, particularly with how these changes might affect existing awards, because you don't just want to blindly adopt them. You want to make sure you have joint approval on how you're interpreting this. And also communicate with your subrecipients, make sure they're aware. They should be attending trainings like this. They should have got this guidance. but they may or may not be aware of that. So make sure that if you do have subrecipients, that you're communicating this with them and making sure they're following the current policies.
Hey, Will, I'm going to interrupt again. Somebody asked, are these thresholds for audits related specifically to federal/state government grants or overall charitable contributions?
So this is the federal uniform guidance. So any federal awards that fall under that under 2 CFR 200. So if you have other state grants or other requirements, they're still going to continue to follow whatever guidance is in effect for them. Now, I will say what a lot of other governmental agencies at state levels and local levels, they generally try to follow suit. And so when the federal government does something like this, a lot of them try to update their thresholds and increase them, but it's not automatic. So do not assume that if, for example, you have some state award or some local award that is requiring something and it also happened to have been 750,000, that was probably just created to align with the guidance at whatever time that was created. You would actually need to see a change in that entity's guidance. This is just for the federal.
Okay, and one more question going back to your first topic. If we receive a grant at the end of 2026 that says it is for 2027, is that restricted? It sounds like it's conditional. Do we record it differently?
So in that case, that's a very common scenario. The in that would be a restriction. So that would if the grant says that we want you to use this funding during the next calendar year, that is a time restriction. So you would record it as a restricted contribution, but that is not a condition. There's inherently nothing in saying that you have to use it next year that affects your right of return or your ability to control and earn those funds. So that wouldn't be a condition. So you would recognize that revenue in this year when it was promised, but it would be a restricted contribution. And then next year, as you incur those costs, you would release that you would take it from the donor restrictions to the unrestricted as you incur those costs. So hopefully
Thank
that
you.
clarified. So next section, I know we're coming up on time a little bit, so I'll go through these somewhat quick. But lease accounting, so if you remember, this came out a couple years ago, so all of you should be somewhat familiar with it, but maybe there's still some ambiguous topics within this. The very short summary of the new lease guidance was under the old, everything was off balance sheet. So when you signed a lease, you just expensed it as you went. If you remember, there was a footnote that talked about what those lease commitments were, but there was nothing on your balance sheet, no assets, liabilities. The new guidance, ASC 842, you basically take the payment stream, so whatever that footnote looked like, you discount that back to today's money and you take that present value and that becomes the starting basis for the right of use asset and the lease liability that you would recognize on your balance sheet or statement of financial position. So really didn't change much about the expense generally, but the 5-second summary is its balance sheet recognition of leases. There is the last bullet point there. There is a practical expedient that all of you should be adopting and using. If you don't, please put this in your policies that any lease that's 12 months or less, you can exempt from 842. So you don't need to capitalize an asset and liability. Makes your life exponentially easier. So if you don't have a policy that says that you're electing this expedient, create that whenever we hang up on the call. So on to the next slide. So this is just a little bit of a compare and contrast of what the two different types are because you can have an operating lease or a finance lease. This is somewhat similar to the old concept where it was operating or capital. So finance effectively replaced capital leases. So in both cases, you discount your liabilities back or your future payments back. The discount rate methodology is the same. Now, granted, I will say for nonprofits, as long as you're not considered a public business entity, you can use the risk-free rate election. That's another one of those practical expedients all of you should be using. It's much easier. So if you sign a new lease on June 1st and it's a 5-year term, you just look up what a treasury rate would be for a 5-year T-bill on June 1st, and you use that as your discount rate. And in both cases, you consider termination options and extension options. This is one area I was going to spend a minute on because we see a lot of issues and errors here. Most office leases will have a provision in there that say that there's an option to extend for another 3 years or 5 years. The standard to include that is that the term is it has to be reasonably certain that you're going to execute that. And that is a high bar. It's not intent alone. So we talk to some of our clients and some folks that work in accounting that say, oh, we intend to execute that. Intent alone is not reasonably certain. Reasonably certain is a high bar where there basically has to be an economic certainty that you're going to do it. So you've invested a ton of money in leasehold improvements, or maybe it's your only facility, and if you had to move, you couldn't operate the same way. So there has to be some real economic incentive. It can't just be, well, we don't want to move. Because if it is that, then you do not include that extension option in the lease term when you're going through 842. And one other thing I was going to highlight on this page. So in operating, you have a single lease expense, where in finance, you have amortization plus interest. So in both cases, when you're going through and you're discounting the payments back, you both models have you impute effectively what's called an interest. But when you're an operating lease, the amortization of the right of use asset and the imputed interest, you still call it rent expense in your income statement. As opposed to in a finance lease, you when you're amortizing the right of use asset, you call that depreciation and amortization. And when you have that imputed interest, you put that with your interest expense. So it's a little bit of a different presentation there, but it is important because it affects basically all the points that come below that are a result of that interest being part of rent or not. So it has a higher EBITDA whenever you have a finance lease. It has a more front-loaded expense. Um, so just be aware that there are some differences between the two. And there are but the disclosure requirements are very similar in both cases. So I already touched on a couple of these common issues, but a lot of times we see that there's just not good documentation or strong policies around determining some of these things. I already touched on the extension and termination options. One I wanted to touch on, commencement date. This is another one that we see very common issues on. It's the third to last bullet point there. Um, Very common that you might sign a lease for new office space, and maybe that lease starts December 1st, but you get access to the space in October in order to do some updates. So within the model, it says that the commencement date is whenever you can control the space. So if you get in early and you're able to do some upgrades, you might actually start that lease on October 1st instead of December 1st. So keep in mind that the commencement date is really about when you can control the space. We see that common issue a lot of times. Um, and then with leasehold improvements, there's an accounting owner concept. So again, a lot of times when you sign a lease, there might be a provision there that says that you're going to get an allowance for $100,000 from the landlord. There's a question as to whether or not what is that $100,000 going towards? Is that flooring and carpet stuff that you're not going to be able to take with you, or is that highly customized stuff that only you're going to be able to benefit from? And whether, depending on the determination of that, it either is or is not part of your 842 calculation. So then the last section, just a couple quick updates from a technical perspective. Um, Probably the one that's mostly going to be applicable to the folks on this call is this income tax disclosure. The 10-second summary of this is that there's additional disaggregation disclosures that are going to be required for income taxes, starting with years, basically calendar year 2026 and later. So really, there's more disclosure requirements between what income taxes are you paying to federal, state versus foreign. So we know most nonprofits don't pay income taxes, but if, for example, you have unrelated business income or you're paying or you're filing in your 990, if you have a 990T where you actually have some taxes due, you're going to have to disaggregate that between federal, state, and foreign. So just a little bit of enhanced disclosure requirement to be aware of. So things to do now to prepare for that is just get a hold of what income taxes you're paying, understand who you're paying them to, and just be prepared for that disclosure to be included in your financial statements going forward. The next one, credit losses. Again, I'll give you the very short summary of this. We expect virtually all entities to adopt this. This is new practical expedience. The very short version is that under the CECL model, which is the credit loss model. So, for example, when you're thinking about receivables and whether you have a provision for bad debts, this guidance came out and now allows management teams to consider subsequent collections when you're determining your reserve. So, for example, when you get to your year end and you have your receivables and you're trying to say how much of this are we going to collect, and you're going to recognize a reserve for the uncollectible portion. Now, what you're allowed to do is you're allowed to look at subsequent collections. So, if you're at calendar year end and you're in March and you've collected 99% of your receivables, you're allowed to say, well, we collected 99%, so maybe the reserve is only 1%. Historically, you weren't allowed to do that. You had to make more assumptions and assertions when you were going through. So really, this just makes your life easier when trying to come up with that estimate, which is why we would expect that most entities will adopt this. Um, so that's really the summary of that guidance. Again, that's applicable starting for calendar year 2026 and later. And then the last one, I'll go through this one very quick because this technically, definitionally, is not applicable to nonprofits. This is ASC 832 for-profit entities. But we brought it up here because this is really about when for-profit entities are receiving government assistance. So a lot of you may remember years ago when PPP loans were out, there was no firm guidance on how to record that. There was analogizing to a debt model, there was analogizing to a deferred revenue model. What this did was it basically recognized, hey, we don't have an accounting model for this. So we're going to create this for-profit entities so that they have something that they can lean on whenever they're getting government assistance. So again, if you are here on behalf of a nonprofit, this definitionally is not applicable to you. But if you work for other companies, maybe you're just a board member at a nonprofit, or maybe you're a nonprofit that has for-profit subsidiaries that's receiving government grants. So what this really does is it creates definitive guidance where you either recognize it like a deferred income model, or you recognize it as essentially like a subsidy of an asset model. So there's a lot of different paths that goes down, but basically the purpose of our presentation here was to let you know that there is now guidance for this. It's several years down the road. You can see the bottom point there. It's not applicable until really calendar 2030 audits, but it's something to think about if you are a for-profit entity receiving government grants or assistance. So apologies, I know we rushed through the last part of that pretty quickly, but if there's any other questions, happy to answer those now.